Hello and welcome to this episode of Nucleus Wealth Empower. I'm Shelley George, Chief Operating Officer at Nucleus Wealth, and I'm coming to you today from the lands of the Wurundjeri people of the Kulin Nation. So today we've got Nucleus Wealth Senior Financial Advisor Sam Kerr back with us again. What a pleasure. So he's going to talk to us about some of the changes that have been made to superannuation starting on July the 1st, 2022, and what they might mean for you. So Sam, welcome back to the show.
Thanks, Shelley. It's a pleasure to be here.
Great to have you. Thank you. So before I forget, just a few reminders. So firstly, please keep in mind that anything we discuss today on this show and any advice is going to be general in nature. And so it's not necessarily going to relate to your personal circumstances. But if you would like to discuss anything, you can get in touch with us on 1300 623 863 or contact at Nucleus Wealth. Also, did you know Nucleus Wealth offers personalised investment portfolios as well as limited investment advice? So you can find out more at nucleuswealth.com, or you can give us a call on that aforementioned number. And lastly, if you haven't already and you like what you are hearing and seeing, please subscribe to our show either on YouTube or whichever podcast platform you typically use. And you can use the notification bell to be notified when we're going live or when there's a new episode to watch. Doing all this will help our show grow and help us to continue to bring this great content that we hope you enjoy. All right, so let's get into it. So, Sam, first one, some good news for most people, or at least most people who are working. We've got an increase in the SG guarantee, or contribution, sorry. Can you tell us what this means?
Yeah, sure thing. So 1st of July 2022, the SG rate went from 10% to 10.5%. So like you said, good for most people. Most people got a pay rise, but you do have to check the terms of your contract, because if your contract is a total package, what may have happened, let's say your total package is 110,000, you get 100,000 in salary and then 10,000 previously in super. With this, if your total package stays at 110, what may happen is your SG may go up, but your salary may go down slightly to keep it at that 110. So something to be aware of, something to look out for. It may be worth trying to renegotiate that increase with your employer. Just throwing that out there. I'll leave that one with you. This is good for most employers because most employees are going to get that 0.5% increase. Not so good for businesses because it's legislated that the SG rate is going to go up by 0.5% a year, every year on the 1st of July up till the 1st of July 2025, when that SG rate is going to be set at 12%. So that'll be set at 12% going forward from that date. So that's sort of it in a nutshell, but there's one other thing I just want to touch on. If you've got an existing salary sacrifice agreement in place with your employer, it'd be worth reviewing that, especially if you're salary sacrificing right up to the concessional contribution cap, which is currently $27,500. Because if the employers put in slightly more and you're still set at the previous rate, that may push you over your the $27,500 cap if you don't have any available catch-up contributions. One thing worth looking at there as well.
All right, great. Thank you, Sam. So, and then the next one, I believe, we have an abolishment of the $450 monthly threshold. So what does that mean?
Yeah, so previously the 1st of July, if you earned less than $450 in a month, your employer was not legally bound to provide SG contributions. So that's been abolished, which is great because that's more often the workers that are doing less than $450 per month. They're often the workers that need it the most. Often part-time workers, people with a second job, maybe some elderly workers that are just doing a little bit of work here and there. So I think it's an excellent change. It's making a fairer system for all, so that anybody that is employed in this country will receive extra contributions for any work done.
Yeah, this is a really exciting one. And I remember when we were talking about it earlier on before we started the show that you were telling me that sometimes people might have a number of casual jobs that mean that they could have less than $450 earnings coming from a number of different sources each month. It adds up to a total of more, and now it means they're going to get super. And I just thought, actually a really other important point to highlight there is now that you're getting super, make sure it's all going in the one super account so you're not getting slugged with multiple sets of admin fees. So if this one matters for you, just do a little bit of admin to keep that in mind.
Yeah, good point, Shelley. Yep.
All right, moving on to the next one. So we have the minimum drawdowns for pension accounts. They're going to keep this 50% discount in again. Is that right?
Yeah, that's right. So this reduction, 50% reduction in the minimum drawdown from pension, that came in at the start of COVID. So that's going to stay in place. One really good thing about this is, the potential to mitigate sequencing risk. And what that is the sequence of investment returns really matters in determining how long your funds are going to last for. And this is particularly important close to retirement or in early retirement. Because if you get negative market moves, let's say at the start of retirement, that can really, and you're forced to draw down on that, which you are in pension phase of your superannuation, that can really accelerate the depletion of your account. And as many of our viewers are likely aware, global markets are down at the moment. So this 50% reduction could come in really handy for lots of clients. If they don't particularly need the money, they can just put off making those withdrawals till a later date. And we've also got that table there, Shelley, that just shows those minimum withdrawals for our clients there as well.
Great, thanks, Sam. Sorry, I should have asked this at the start of the point, but what is the minimum drawdown?
So if, let's say, well, you can see there below age 65, it's 4%, and that's currently half to 2%. And then it goes up each year. Oh, sorry, each age bracket. You can see the brackets there, 65 to 74, minimum 5%. And then the maximum drawdown is when you're over age 95. You have to draw down 14% per year. And I believe the reason this is, in pension phase, it's a completely tax-free environment. So there's no tax to pay on any earnings, capital gains, or withdrawals. So in my view, the government wants you to get your money out of this tax-free environment, get it circulating around the economy again so they can generate tax revenue on that. So yeah, that's my sort of understanding of how that works.
Right. Okay. So what this table is saying is that if you have a pension account, then for whatever age you are on the table, then you have to take out at least that percentage of the balance each year. Is that right, my understanding?
That's right. That's absolutely correct.
Okay. Fantastic. Thanks, Sam. All right. So the work test has been abolished. What does this mean?
Okay, so it's been abolished for people aged between 67 to 74. And the work test previously, what that is you have to work at least 40 hours within a 30-day period in the year that a contribution was received into super. So yeah, that was for people that have maybe retired and they're still doing a little bit of part-time work, then they're still able to make contributions into super.
Sorry, just to interrupt you there, I just want to clarify, when you say contribution into super, you can only contribute into your accumulation super account. There is no function to contribute to pension phase, or have I got that wrong?
Yeah, that's correct. Yeah, so you can only make contributions into your accumulation account. Okay. But you can have a pension account and an accumulation account simultaneously. So you can be in pension phase, making those minimum withdrawals in retirement when you're retired, but you can also still have an accumulation account and receive contributions into that. And you can transfer those funds across to your pension account through a pension refresh. So you can get those funds into that tax-free environment.
I see. Yeah. All right. Thanks for clarifying that.
Yep. So yeah, this work test has been abolished, which is a great thing. So people now have less barriers to getting money into super when they're retired. So this applies for after-tax contributions, so non-concessional contributions, but does not apply for pre-tax concessional contributions. So those are SG contributions, salary sacrifice, and personal deductible contributions. But if you're still working, you'll likely be able to make those anyway. So this is just for after-tax contributions. So, if you receive an inheritance, a windfall, maybe you sell a property, something like that, you can then get that money into super, into the low tax environment of accumulation phase, and then transfer it into that zero tax environment of pension phase. So it's more likely to be a better place to have your money invested rather than in your personal name, because you have to pay tax at your marginal tax rate, whereas you're either paying tax at maximum of 15% in accumulation phase or 0% in pension phase.
Yeah, all right. This one's really interesting, and it sounds like it could apply to quite a few people. So definitely one if that it could be applicable to you to look into. It sounds like, Sam.
Yeah, absolutely. Another great thing about this new rule is it opens the door to what's called a re-contribution strategy. So this has been around for a long time. This is nothing new, but this really opens the window to be able to take advantage of this in a more meaningful way. And just to give you a big picture overview of how a re-contribution strategy works, is what it does is it effectively eliminates any death benefits tax payable to any beneficiaries that are non-tax dependents when you pass away. So to give you an example, a non-tax dependent is an adult child. Whereas, if you pass away, your super will go tax-free to your spouse. Your super will go tax-free to any children under 18. But there is this super death benefits tax to pay if you want your benefit to go to a child, an adult child, one of your children that's over 18. So that death benefits tax is 15%, and then there's a 2% Medicare levy to pay on top of that. Shelley, does that give you a bit of an idea?
Yeah, absolutely. And it sounds quite significant when you're talking about basically 17%, which is that 15% plus the 2%. So I see that you've got an example here on the slide for us. You want to walk us through how it would work?
Yeah, absolutely. I think it's best just to walk through an example. It's a little bit complex, but please bear with me. And Shelley, pull me up if there's anything that it's just way out there that no one's going to understand.
Okay,
but
thanks,
yeah, and disclaimer as well, it's always best to seek advice from a licensed financial advisor. So if you do want to have a general conversation about this with me, more than happy to have a conversation. So you can reach us on 1300 623 863 or go to our website, nucleuswealth.com/contact, and you can book a call with me there as well. More than happy to talk through the intricacies of this. So let's say you have 330,000 in your pension account that you're likely not going to need, and it's sort of earmarked to pass on to one of your adult children. So how this works is you would withdraw that amount, 330,000, from your pension account, put it into your bank account, and with the funds in your pension account, we're going to assume they're all a taxable component. And so what that means is that's either an SG contribution, a salary sacrifice contribution, or a personal deductible contribution. So we're going to assume that that's those funds we're pulling out are all of a taxable component. Then what we're going to do is we're going to recontribute that 330,000 into your accumulation account as an after-tax contribution, so a non-concessional contribution, and then that'll now be classed as a tax-free component. So we've changed it from a taxable component to a tax-free component. And if previously, if you were to pass away and the money was to go to your adult child and it was a taxable component, you would have to pay that 15% plus 2% Medicare levy. So that'd be $56,000 in tax. But now that we've recontributed that as a tax-free component, as a non-concessional contribution, now there's no tax to pay and then no death benefits tax to pay. So you've effectively saved yourself $56,000 in tax, and the beneficiary of these funds is going to be $56,000 better off. So you can either leave the money that you recontribute back into super in the accumulation phase, or you can move it back to the 0% tax environment of pension. So you've got that flexibility there. And if you do actually need the money, it's still available. And this opens. One thing I forgot to mention is the 330,000 non-concessional contribution. We're taking advantage of the bring forward provisions. So you can put a lump sum of 110,000 in each tax year, but you can do a bring forward for the next 2 years. So you can put 3 years, 330,000 worth in a lump sum contribution, taking advantage of those other 2 years. Where I'm going with that one is, let's say you're 65, you do that in that year, utilizing the bring forward provisions for 65, 66, 67. Then you've got the ability to do that again for the next 3 years, and then you've got the ability to do that again if that's what you wish to do. Before you turn 75. So when you're 74, that's the window of opportunity, 65 to 74 now. And one other thing I want to just make clear, there are a few more intricacies to this strategy. You have to, your total superannuation balance has to be less than 1.7 million. So again, please do discuss this with your licensed financial advisor. But yeah, Shelley, is that clear on
yeah, definitely.
the benefits?
And also really significant. I mean, it's $56,000 is a lot of money. And so it sounds to me like the key points that you have highlighted that sort of enable a person to do this are that it's a non-concessional contribution back into accumulation, and that you want to check what you have available to you in terms of bring forward. And then a couple of other things around your balance and that sort of thing that you might want to check with your financial advisor or accountant just to make sure that you're getting this right. But as you highlight in your example, it can certainly be worthwhile.
Yeah, absolutely. And, if your spouse does this as well, the benefits can really add up, and that can mean a lot more money to some loved ones or whoever you designate to be the beneficiary. And, I think one more thing I want to add is the government is making it easier to get more money into super. And I think that's because, if more people are self-funded retirees, then there's less dependence on the government and the age pension. So it's a less of a liability for the government there. But the recontribution strategy, I think that's sort of maybe that's an unintended consequence of these new rules, but a good one.
Interesting. All right. Well, maybe then keep in the back of mind to take advantage of it while it's still there.
That's right.
Because as we know, we've got 8 things this year that we're highlighting for changes to super. It's an ever-changing beast, despite there being plenty of pressure on governments for it not to be. So we've still got 4 to go. So moving on to number 5, we've got the Downsizer Contribution. So what's changed to this, Sam?
So the age for the eligibility has changed from 65 down to 60. So just quickly how the home downsizer contribution works. If you've lived in your principal place of residence for longer than 10 years and you sell your property, you can contribute up to $300,000. So that's each person within a couple. So you can do a maximum of $600,000 if you're in a couple, and you can put that into super above and beyond your total super balance. So this is a really great way for people to get more money into super. And like I've talked about when we did this, we've actually done a Nucleus Wealth Empower podcast on this. It's so many people have so much of their wealth tied up in their home, and this is a good way to access some of that to help fund your retirement. If you sell your property, there's no requirement to purchase a new property, and there's a few more rules obviously around this. So best to talk to a licensed financial advisor again. But one other point I want to make is I think this is a really good move because it aligns much better to most people's preservation age, which is age 60. And that preservation age is when you are able to access your super. And a lot of people may be wanting to retire earlier at age 60. And but like I mentioned before, got a lot of their wealth tied up in their family home, and this allows them maybe to release some of that equity to help fund their retirement and potentially retire a bit earlier.
Okay. So actually just wanted to clarify on this one, is a contribution made in accumulation phase only, or can it be made in pension? Which is, I know, kind of contradictory to the question I asked earlier on, but I wasn't sure.
I believe it's accumulation phase.
All right, so nothing to check out.
Yes.
Okay, so from downsizer contributions to something for the younger generation, a bit exciting for me, I am biased, the first home super saver scheme. So what's changing here, Sam?
Yeah, so from one end of the spectrum to the other, the older retirees got significant wealth accumulated in their home, trying to release that. And then the other end of the spectrum, we're trying to help first home buyers get into the market as property is expensive in Australia. So at the moment, you can use you can use pre-tax contributions into super to save for your first home. So that's increasing from 30,000 to 50,000. And how that effectively works is instead of saving with after-tax dollars outside of super, you can save with pre-tax dollars within the super environment and then release those funds to get that first home deposit. And instead of paying tax at your marginal tax rate, you're paying tax at the super contributions tax rate, and you're getting the difference there, that added tax saving. So that's sort of the main benefit of that. Again, Shelley and I, we've already done a Nucleus Wealth Empower episode on this. So please do go and have a look at that. What we try to do at Nucleus Wealth is we really try to look for more ways to add value for our clients. And this super saver scheme, if you're eligible, it's a great way to get that first home deposit as well.
Thanks, Sam. So we'll put that episode as well as the one that you previously mentioned about downsizer contributions in the show notes. But on this one, I just wanted to clarify before we move on that the pre-tax contributions have to be additional to your SG contributions that your employer makes for you. You can't take it out of those, can you?
Yeah, this is voluntary contributions, so okay. Yeah, additional to the SG contributions.
All right. Thanks, Sam. Okay, so staying in housing still, the home equity scheme. So what changes have happened to this?
Okay, so the Home Equity Access Scheme, it's recently been renamed from the Pension Loan Scheme. And what that is it's effectively a reverse mortgage for pensioners. So if you're receiving a pension or a part pension, it's a government scheme that allows you to access the equity in your home through a loan agreement, a reverse mortgage effectively. And it's intended to help fund your retirement. So to top up any money that you're getting from the pension or from super, you can stay living in your home, but access the equity in your house. So what's changed is, so normally you just get fortnightly payments. That still stays the same, but you can actually get a lump sum payment now as well. So they're changing, just making it a bit more flexible and aligning it more to retirees' needs. In retirement, many unforeseen things are going to come up. Whether it's medical expenses, home improvements, maintenance, those types of things. So now you can actually get a lump sum rather than just the normal fortnightly payments. So a bit more flexibility there. The other thing that's really good is there's a no negative equity guarantee. And what that means is the total of the loan can never exceed the market value of the property. So it's a really good move because there are considerable risks with this type of reverse mortgage, and a lot of people have got into trouble with this in the past. And the value. Yeah, sorry, go ahead, Shelley.
Sorry, Sam. So who provides the loans? Is it the bank or the government?
Yeah, this is a government-funded scheme. So
okay.
It's from the
so
government.
Now they have something in place to make sure that the value of the loan can't exceed the value of the house.
That's right. And you can repay that loan at any time, but most people repay it when they actually pass away with the scheme. So stay in their home, tap into the equity, and then pay the loan off once they pass.
This one's really interesting to me because I know, certainly you've all heard of people that want to downsize their houses too big, but I've heard of plenty of people that very much want to stay in their home. So I think that this is really significant what they've done and will be impactful for people here.
Yeah. Again, please do go and seek advice from a licensed financial advisor because the interest rate is generally a couple of % higher than, say, the standard variable mortgage rate that are available to retail clients, and the interest is compounded. So yeah, so there's some risks involved as well.
Yeah, right. So you definitely want to know what you're getting yourself into. Okay.
Absolutely.
Like most financial products. All right, moving on to the Commonwealth Senior Health Card. So I do believe this is actually number 8. So thanks for bearing with us. We're nearly at the end there. Sam, what's going on here?
Okay, so the eligibility is increasing significantly. So if you are ineligible for a pension because you have your asset base is too high, you can get what's called a Commonwealth Senior Health Card. And if you fall within certain caps, so there's great benefits for having one of these cards. A lot of retirees really want to get their hands on one of these as any way they can. You get bulk billing for a lot of doctors, cheap prescriptions, refund on medical costs, lower utility, property bills, lower water rates, cheaper public transport. And it's a real status symbol for a lot of retirees. So the eligibility for this is increasing. So about 50,000 extra Australians will be eligible. This was an election promise by both the major parties. It's not yet legislated, but will be very shortly. So yeah, you've got that table up there already, Shelley. So I'll just explain how it works. So there's no asset test, but there's a deemed income test. So what deeming is it's a pre-prescribed rate of return for your investments. So you can see there for a single person, the first 56,400 in assets that you have is deemed to earn 0.25% income per annum. So even if you get a higher return than that, it's still going to be deemed at that amount. And then anything over that amount is deemed to earn 2.25% per annum. And you can see for a couple, first 93,600, 0.25%, and then anything over at 2.25%. So currently what that means is you can have 2.3 million in assets as a single person outside of the family home. But this includes, your house contents, includes your cars, and all investment assets and financial assets, but excluding the family home. So if you had 2.3 million, excluding the family home, and it's deemed to earn 57,761. If you have under that amount, you can get the Commonwealth Seniors Card. For a couple, it's already pretty generous, 4 million outside the family home, with a deemed income of 92,000 there. So these rates are going up. So for a single, it's going up to 4 million, and for a couple, it's going up to 6.5 million. So if you have under those amounts, you're going to be eligible for this health card, which is good news for a lot of people.
I have to say, looking at this slide, I'm silently laughing over here because they make it look like it's an income test, but when you go through the example, you realize you get there by doing an asset test. It's a backwards way of doing an assets test. So I guess to simplify it all, you could just look at the new effective caps from July 1, 2022, couldn't you, Sam?
Yeah, essentially. So if you had 6.5 million as a couple, it's deemed to earn 92,416. So a little bit different to some of the other tests within pension to get the pension.
That said, I think you've done a very good job explaining it. Thank you, Sam.
That's good. And arguably these are the people that need these concessions the least. But I'll leave that up to you to decide what you think of these changes that have been made.
A very diplomatic end to the show, Sam. Thank you. Not quite so diplomatic as your article, which we'll also put in the show notes.
Yeah, you can feel free to have a read.
Okay, so thanks again for your time. You bring so much value to our listeners, so I really appreciate that. Can you let them know where they can hear more from you or read more from you or get in touch with you?
So at this part of the show, Sam told us all about where we can actually get in touch with him, but unfortunately we had a technical difficulty and the audio stopped recording. I apologize for that, and we will endeavour to better in the future. So I've had to go back and record it. But basically, if you would like to get in touch with Sam, there's a number of ways you can do that. In touch with him, or either follow him and the articles and podcasts that he produces. So all of the ways are through nucleuswealth.com. So you can go to /contact if you'd like to have a meeting with him to discuss the investment advice you're getting from the Nucleus Wealth portal. Alternatively, if you would like to subscribe to the Nucleus Wealth alerts and the weekly emails, then you can find out there any articles he's produced, as well as any of our investment team. And of course, the weekly podcast that he produces with Damien Klassen, 12:30 Australian Eastern Standard Time every Thursday. Right, so to wrap up the rest of the show, I'd just like to say that if you have any feedback for me about this episode or any ideas for future podcast topics, please get in touch with me either in the YouTube comment section, or you can send me an email at contact@nucleuswealth.com. And if you know anyone you think would get something out of this episode, please share it with them, maybe a friend, a family member, or a colleague, and help our show grow so we can keep producing more great content for you. Lastly, thanks again for tuning in from myself and the team, and we look forward to catching you again at the next one.